In this video, I'm going to show you how you can make $5,000, $10,000, or even $15,000 a month using one of my favorite option strategies for safe and consistent income, selling put options. I'm going to show you my real trades that I made recently and share with you my exact thought process, the stocks I picked, and my reasoning for selecting the exact strike price for the option contracts to sell put options. Hi, my name's Gautam, and on this channel, I talk about the stock market and achieving financial freedom with the power of options trading. So if you enjoy content that can help you retire early and achieve financial freedom, don't forget to hit that like button, subscribe to my channel, and share this video with your friends and family. Also, if you are new to the options world or are simply looking for one-on-one guidance to help you shortcut years of trial and error and avoid costly mistakes, click on the coaching link below and I'll be honored to help you out. With that said, let's dive in and get started. A quick disclaimer before we get started. The information provided in this video is for informational and educational purposes only and should not be considered financial advice. I'm not a financial advisor. I'm simply showing you my trades and how I trade. With that said, let's understand what a cash secured put is and how this option strategy works. A cash secured put is an option strategy where you sell put options at a specific strike price for a set time. In return, you collect a premium for taking on this obligation. If at expiration, the price of the stock stays above the sold strike price, you get to pocket 100% premium. In case the price of the stock drops below the sold strike price, then in that case, you are assigned the stock, and depending on the number of contracts sold, you would be required to have enough cash to buy as many shares. Now, one options contract lets you control 100 shares. So if you sold one options contract of a specific stock and it goes below the strike price of your sold put, then you are obligated to buy that stock at the strike price of your sold put. So why do I like this option strategy? Because I get to pocket 100% of the premium as long as the stock stays above the sold strike price. And what happens as a seller of the options contract is that the value of the options contract continues to decay with time as it gets closer to expiration. If the price of the stock drops below your sold put and you're obligated to buy the stock at expiration, you're actually getting the stock at a discount from the price that you originally sold the put option. So that's actually a benefit. And I also use this strategy as a great way to build a position in a stock that I like. As always, you have to ensure that you have enough cash to buy the stock if assigned at expiration. Let's look at my stock selection criteria next. So I generally like a stock that offers decent premiums, and generally my target range is anywhere from 2 to 5%. So that's the first criteria that I look at. Obviously, since there is a possibility of getting assigned when selling put options, you want to choose a stock that has strong fundamentals and growth prospects. So you want to choose a stock that when you look at the earnings and revenue, that you see that it's consistently increasing quarter over quarter and the stock looks like it's growing well and has good future growth prospects. Again, this would be a stock that you're comfortable owning if assigned. And last but not least, you don't want to choose a stock that is a meme stock just because it offers great premiums, because you don't want to be a bag holder. A lot of times people sell put options on meme stocks just to cash in on the nice premiums. But again, if you end up getting assigned, you could be bag holding for a while, and that's exactly what we want to avoid. So now that you understand the cash secured puts option strategy and what to do and what not to do, let's go over to the actual trades that I made and how you could leverage these trades to make anywhere from $5,000 to $15,000 or even more, depending on the capital you can allocate. So let's go over to the first trade that I made. Now, today's Tuesday, July 22nd. I made these trades this past Friday on July 18th. And generally, what I like to do when I sell put options a week out or a month out is to look for a red day. Now, you may ask, why sell puts on a red day? It's because the premiums that you would collect when selling on a red day would be much higher than the premiums you would collect when the stock is actually trending upwards or on a green day. So generally speaking, I look for a day when the stock is actually going through a pullback, and that way I ensure that at that moment I collect the best premiums that I can selling the put options a week out or a month out. So having said that, let's look at the 6-month chart for my first stock pick, which is American Airlines. So American Airlines is a great stock if you have a small account. It's only trading around $12.50 right now. and does offer great premiums. So looking at where it was trading on July 18th, I started looking at some support levels for where I would like to sell put options. Now, in this case, I went with the monthly option because we have earnings coming up on July 24th, which is actually a couple of days from today. So keeping that into consideration and also taking advantage of the uptick in implied volatility, I wanted to take advantage of that, but at the same time, choose a strike price that I'd be comfortable owning the stock. So I went out about 30 days and then again, looking at some support levels. So we have some support right here underneath at the 1183 level. That also is actually the middle of the Bollinger Band. Then we have some additional support at the 1159 level, which is the 50-day moving average. And then obviously you have the bottom of your Bollinger Band at the 1083 level, knowing that we have earnings coming up and the stock can obviously go in either direction after earnings. Even on good news, you could see stocks trending downwards because if the market doesn't like anything that they see, or they see shrinking profit margins or a reduced guidance in the future months or for the rest of the year, then the stock can turn downwards. So keeping all of those things in mind, I wanted to choose a strike price that I'd be comfortable owning American Airlines, and especially keeping in mind that I was going 30 days out. So let me go ahead and show you which strike price I went with. So I sold the August 15th puts. I went with the $11 strike price. And again, going back to the trade, I sold 25 contracts at the $11 strike price and I collected a premium of 27 cents per options contract. So let's do some math here, right? So I collected a premium of $27. We have a strike price of 11 times 100 shares, so that would be 1100. So if I went a month out, this is a return times 100. This is a return of 2.45 for selling puts out about 30 days. Not the greatest, but again, I'm targeting anywhere from 2 to 5% on companies I wouldn't mind owning. Since we sold 25 contracts, you see right here, this column right here, it says cost, but since it's in parentheses, this is the premium that we collected. So I collected $685 selling 25 contracts of American Airlines at the $11 strike price. My next pick was Affirm Holdings, and I actually just did a video of new stocks that I just added to my watch list, and Affirm is one of them. So check out the link of this video right here. And I do a detailed analysis in this video as to why I like Affirm and why I'm adding it to my watch list. So having said that, I have the Affirm 6-month chart pulled up right here. And again, I'm going back to July 18th, which is this past Friday. And as you can see, after 4 green days in the row, this was the first red day. And I wanted to take advantage of that and pick up some nice premiums. So as you can see right here, we had Affirm open at $69.39, made a high of about $70, and made a low of about $66.94. Closed the day around $68.90. I saw some support obviously at the low of the day, which was $66. And then there was additional support right here at the bottom of these candles, or this big red candle was showing me a support at 64.54. Now, obviously, we've had few more days of activity. And if you look at the bottom of the Bollinger Band right here today, it's close to the $64 range. Now, this trade, I went with the weekly option on this trade because I wanted to stay close to the current price of the stock. And keeping that in mind, I sold 4 contracts of the $64 strike price. And for that, I collected a premium of 51 cents per options contract, or basically $51, which is 51 cents times 100 shares. And let's see how much of a return that is. We collected $51, so $64 strike price times 100 shares. That's $6,400 per options contract. And that is a return of 0.007. And again, this is a weekly options contract. So if I were to do it times 4 weeks to see what it would be on a monthly basis, and then do times 100, that gives you a return of almost 3.18% monthly. It's in the target range that I target, anywhere from 2 to 5%. This is a good rate of return, and I like Affirm. So again, this was my second trade, and I sold 4 contracts and I collected $204 selling 4 contracts on Affirm. My next pick was Robinhood, and going back to July 18th, we saw that after 3 days of moving upwards, Robinhood had a pullback on 718 again this past Friday. So I wanted to take advantage of that. And looking at how Robinhood traded, it actually opened the day on 109.75 that day, made a high of 113, and closed the day around 109. So again, since it was trending downwards, I looked at some support areas. And obviously, the next support area at the time was the previous candle or the high of the previous candle, which was 105. But again, that was too close to the bottom of that candle. So I looked for some additional support, and I saw some additional support at this $99 level or 99.71. So keeping that in mind, I went a little aggressive with this one and went with the 101 strike price. And for that, I collected a premium of 92 cents, which is basically $92 per options contract. And I sold four puts at the 101 strike price, collecting a total premium of $460. And again, those are for expiration for this Friday, July 25th. So let's do some math here. We collected 92 cents or basically $92 at the 101 strike price, which is 101, and then adding two more zeros times, so to get the 100 shares, and that is 0.009 per week. Now, if I were to do this for 4 weeks and then times 100, that would give you a return of 3.64%, which is great returns on a stock that I don't mind owning. And at the same time, if I don't get assigned, then I keep 100% of that premium. My next pick was Snap. And again, it's another stock that I like. If you have a small account, it trades around $10 and offers good premiums. It's not profitable just yet, but I still like the stock. I believe it's going nowhere. And with everything that's going on with TikTok and the uncertainty surrounding TikTok, I believe that it's a good alternative. I have a teenager in the house and she uses Snapchat on a daily basis. So I know it's popular among the young generation. So with that said, I have the Snap 6-month chart pulled up right here. And on Snap, you see this big red candle right here. This is July 15th. So I wanted to take advantage of that opportunity. Snap, also with earnings coming up, I wanted to go ahead and sell puts at least a month out. So keeping that in mind, I sold the August 22nd puts, which is about 37 days out. So looking at some support areas at the time, the bottom of this candle was almost 944. I looked at the expected move of the stock. It was a little bit under the $8 strike price. So keeping that in mind, I went further out than the earnings week, and I went with the $8 strike price on Snap. The $8 is actually at the present moment right at the bottom of the Bollinger Band. So I'd be comfortable owning Snap at that price point. So let's go over to the trade that I made. I sold 20 put options for the August 22nd expiration date, and I went with the $8 strike price. As I mentioned, I collected a premium of 33 cents or $33 per options contract for a total amount of $660. And this is selling 20 put options. So let's do the math and see what kind of a return we got. So again, we collected $33 and then we went with the $8 strike price. So 8 times 100 shares. And that would basically give you a return of a little over 4%. So this is 4.12%, which is fantastic. Keep in mind, it adds an additional week. We went 37 days out instead of 30 days out. But nonetheless, it gives you an idea that the return was fantastic. Again, a stock that I wouldn't mind owning. And if I don't get assigned, then hey, I get to pocket that premium. So for my final trade, I went with SoFi Technologies, and SoFi needs no introduction. I've done a lot of videos on SoFi. It's one of my favorite stocks to trade. And not only that, it's actually one of the best stocks to trade under $30. It used to be one of the best stocks to trade under $20, but given its current price, I believe it's probably one of the best stocks to trade under $30. So given that SoFi has had quite a nice run over the past week or so, I was looking for an opportunity for a pullback last week. And on July 16th, I sold 10 contracts on SoFi a month out. And basically looking at some support levels right here, and also keeping in mind that we have earnings on 7/29, which is next week, I wanted to go ahead and give myself an additional couple of weeks and ensure that if SoFi does pull back after earnings, that I am picking up SoFi at a good strike price. So on July 16th, SoFi was trading around $21. And looking at the Bollinger Band at present, obviously the middle of the Bollinger Band is around 1925. And again, the prices would have changed. We have a few more days of activity. And then we have the 50-day moving average currently at this $16 mark, which is, I believe, about $5 lower than the current price. But at that point of time, and looking at the expected move after earnings, I went with the $18 strike price and I sold 10 put options at that $18 strike price. And basically, this is again going 30 days out. For that, I collected a premium of 47 cents or $47 per options contract. So let's do some math here. So $47 and then the strike price is 18. So we times it 100 because one options contract lets you control 100 shares. So that gives you a return of 2.61%. Now keep in mind, I gave myself a little extra cushion. So just in case we have a pullback after earnings, I gave myself a couple of extra weeks. And in that case, give the stock some time to rise back up. And if that happens, for that, I got a return of 2.61%. Not the greatest, but given that it's SoFi, fairly decent. And again, that gives me a little discount from the current stock price, trading around 21 bucks. And then if it does drop to 18, I'd be comfortable picking up SoFi at that strike price. Or if I'm not, I can roll it down even further. So with this trade, I have sold 10 option contracts and collected $470. Now going back to this past Friday, we had an additional pullback or a red day. So I wanted to add on to my existing position. So what I did was I went ahead and sold puts out for this coming week, which is July 25th. And I sold the $20 put. And for that, I got 15 cents per options contract. So let's do some math here. So this is a week out. So 15 divided by the $20 strike price, which is 20 or 2000. And then this is basically times 100. So my weekly return on this week's put options that I sold 10 contracts was 0.75. Again, it all depends on the strike price that you choose. I went a little aggressive with this week because with the pullback and with the earnings coming up, I was actually hoping for SoFi to jump back up. So with this options contract, we have a return of 0.75. And again, if I stayed aggressive and did this trade 4 times in a month, that would give you a return of almost 3%. So as you can see, 2.6% return on the monthly option. But again, I was being safe there, keeping in mind that we had earnings coming up. And then on the weekly trade, because it's expiring this Friday, which is before earnings, I went a little aggressive because stocks generally tend to run up before earnings. And given that I had an additional red day last week, I wanted to take advantage of it. And I went a little aggressive with the $20 strike price. But hey, that's a pretty good return. So now that I've shown you all my trades, let's do a quick summary and see how much money we made selling all these put options. So with my first trade on American Airlines, we sold 25 contracts a month out and collected a premium of $685. For my second trade, this was a weekly trade. We sold 4 Affirm options and collected $204 weekly, which again, if I times it by 4 weeks, that would be a monthly premium of about $816. The next trade was on Robinhood. We sold 5 put options and collected a weekly premium of $460, which again, if I times it by 4 weeks, that would yield you about $1,840 in monthly premium. The next stock was Snap. So for Snap, I sold 20 contracts and collected $660. Now, this was 37 days out. If you'd like to discount it a little bit, that's fine. But it gives you a general idea of how much we collected. And then SoFi, I sold 2 different options, a weekly option and then a monthly option. So on the 10 weekly options, we collected a weekly premium of $150 and then ended up with a monthly premium of $600. If I did 15 times 4, that's $600. And then again, for the monthly option, we sold 10 put options and then collected a monthly premium of $470. So as you can see, all in all, this would yield you a monthly premium of $5,000. And again, to make $10,000 or to make $15,000, you would just multiply the number of options contracts that you sell. You could also diversify and add more stocks if you'd like, but I generally like to go with 5 or 6 stocks that I really like. So that's it for this video, and that's my blueprint of how you can make $5,000, $10,000 or even more selling put options on your favorite stocks. If you enjoyed this video and learned anything useful, Please give it a thumbs up, subscribe to my channel, and leave your comments below with any thoughts or feedback. If you would like one-on-one coaching directly with me, click on the first link in the description below, and I'd love to help you out.